why there is a misalignment in capital allocation when it comes to venture capital really funding, robotic companies? Let me take a step back and, to address this point, because the Silicon Valley, the way we know it over the last, say, 20, 30 years, is different than the Silicon Valley that started in the 60s and the 70s. I mean, that's actually what made America great in the first place. It was very hardware focused. I mean, think about the Intels of the world, semiconductor, the Fairchild Semiconductor Industries, the biggest customers were the DoD, and most of the innovation was really funded by, VCs of the 60s and the 70s. And think about it, Sequoia back then, like, the legendary Don Valentine, or, other names that are escaping me right now because obviously they're kind of dated, and some of them actually no longer exist, either as general partners or companies. But then fast forward, as fortunately or unfortunately, the US has become less industrialized and more service focused, the new wave of Silicon Valley came in, and the famous adage of, software is eating the world by, I think, Andreessen and Horowitz. Most venture capital end up really funding companies that are actually SaaS or software like. So softwares in general scales at the speed of copying. It's not disastrous to fail in a software-led economy. You change a couple of lines, couple of codes, it's fast iterations, usually mistakes are not extremely taxing, and more importantly, actually mistakes in software development are not really visible. So they're visible only to the end user. So you have these bugs, you can debug them, etc., etc. Now, fast forward in an era where robots and human are intertwined. Well, like, the only people that learn how to price risk are venture capitals, at least in early adoption or early tech of a sort. However, the venture capital, the way we knew it in the 60s, was not structured the same way we know it now. It was mostly merchant banking, with LPs that expected return of capital of a sort, but they were not really tied to, 7-year and 10-year lockup of a sort. That had become mostly a norm once they become institutionalized. So hardware was mostly funded by internal VC of corporate America or pool of capital that didn't really care much about the return of capital within 7 to 10 years. Now, the robotic industry is completely different than software, because it's hardware on top of the software on top of AI, and there's a J curve. The problem is VCs usually, when they put in capital behind any company, they would like to see a huge ramp up early on. You burn a lot of cash, but you kind of have different metrics, whether it's revenue or market share, or if you're building an ecosystem, is a percentage of market share you're grabbing, and then the whole model for go fast and literally break things. And it staggers. We give you seed capital, we expect you to come back, for Series A within 12 months. You need to hit these benchmark or milestones within maybe 12, max 18 months, etc., etc. And that kind of compresses time. So by the time you reach 7 years, you're kind of ready almost to have a significant market share or a certain sizable business. Excuse me. So you can actually think about an exit, for your LPs, your limited partners. Robotic doesn't give you that. Robotic is slow, and it's not really optimized for an IPO within 10 years. It's mostly optimized to compound economy of scale past a 10-year period. So whoever is really investing in robotic companies right now, they should not be looking at an exit within 10 years. Can you exit in 10 years? Sure. If there's a market for it, right? If there's either a secondary market or you want to bring things public without them being profitable. We've seen that in the dot-com era, by the way. The problem is you actually reaching a sweet spot after 10 years where really you start reaping a meaningful return on your invested capital. And hence, the model of VC funding robotic company is not fully suitable. There's a duration mismatch. So VC has a duration of 7 to 10 years, and then robotic companies, they have a duration that is like 15 or 20 years. Think about it as funding infrastructure plays, right? It's a highway or building a dam or bridge, etc., etc. When they're profitable, but there is a requirement. But on top of that, the infrastructure, there's no technological obsolescence. A bridge road is a bridge road. A dam is a dam. It's a public utility, but robotic has that on top of that. So it's not only the payback time is a little bit longer, but at the same time, there's technological obsolescence tied to it that requires a combination of patient capital and really venture capital. Something that has high tolerance for failure and a long duration. innovation patience. So, and that's why we see, for instance, the likes of Tesla, getting into the humanoid. Actually, they're transforming the company completely because they just realized that electric car is not an innovation anymore. It's actually, as I mentioned, it's a box, it's a hardware, it's been commoditized, and therefore they need to move on to the next big thing. They focus on humanoid. The advantage is they have permanent capital, publicly traded companies, and they have horizon that exceeds 7 or 10 years. The rest of businesses, whether it's Optronic or Figure AI, they're taking VC money. So it's okay because there's demand for somebody to do that, since growth equities, private equities, and other forms of capital are not ready to take massive risks. So the venture capitals right now filling in that void. But again, there's mismatch in duration. I don't think this is a SaaS play where you can exit it in 5, 7, 10 years. You gotta be more patient with it, and that's enhanced the need for a new permanent capital structure of a sort, or permanent vehicle or vehicles to fund these endeavors. Why are we building a permanent capital vehicle to fund robotic companies? We see a white space. So let's do some math. I mean, an average robot costs between $50,000 and $300,000, depending on their capability. So, I mean, a fleet of robots, can cost you up to $20-30 million. And you kind of integrate it within an existing ecosystem of a sort, the productivity dips in the beginning, because what you end up doing, you end up replacing old processes with a new, almost untested processes. And then when you end up having almost human beings babysitting robots in the process, because you have to integrate them. And then you will start seeing first a dip in productivity. So the endeavor is actually losing your money. So not only is it massive upfront capital, but then the operating income is taking a dip. So you're getting hit both as an operator on the balance sheet and on the income statement. And very few people have that patience, by the way, to endure that. Because if you're funding a business that is losing money at the same time as not producing profit, and remember, robots do not necessarily increase your revenue unless you're in the business of selling robots. You have to integrate it. It's mostly saving you time or money or both. So you're laying out capital to save time and money. You're not laying out capital to increase revenue. Revenue increase will come next. Now, venture capital in general, if they don't see metrics that are accretive to revenue or market share within the next 12 months, they kind of pull out. And hence the need of a permanent capital. Permanent capital, you're not optimizing for an exit, you're optimizing for a compounding return that goes above and beyond 10-year period. Like the late Charlie Munger, the vice chairman of Berkshire Hathaway, the right-hand man of Warren Buffett, said something extremely important, and said that's why Warren Buffett and him are not suited to be operators within the framework of Wall Street. Because he said money making comes from being patient. It's the patient that makes you money, and has the need for permanent capital when you're funding these long-term endeavors. You gotta be patient, you gotta be operationally minded, and you gotta be able to sustain both risks on the software and on the hardware side. And I would add even a third layer is operational. So VCs usually cannot live with hardware risk, software risk, and operational risk. Permanent capital is built for that, and hence us building permanent capital vehicle to invest in embodied AI. A lot of people, when they think about capital allocation, think about debt and equities. They think about the efficient frontier, balancing portfolios. We think about it differently. We see 4 strategy in our allocation model. One, you talked about direct asset ownership. So direct asset ownership is literally, it's an infrastructure like investing. You own the physical robots, or facility, and you lease them back to the operators. So it's predictable yield, the real collateral. The only risk that you are taking is the credit risk of the operator and the technological obsolescence. So these are the 2 things that, we look at. Well, from the operator perspective, we're not going to fund somebody who didn't start in the process. So we come in and we can help them scale. So let's say they have already started the process of creating an autonomous process within their overall process. They have a proof of concept and they need capital to grow. So from an operator perspective, we kind of de-risk it. It's not a greenfield, it's kind of a brownfield investment. From a technological obsolescence, usually things do not renew on a yearly basis. So we have to kind of embed that in our IRR. When do you think we need to get back our money before technological obsolescence become a thing? So I usually use the old adage of, vehicles. For those of you who are old enough, vehicles used to kind of have a life cycle of 5 years, 6 years back in the 90s. maybe early 2000s. So if you buy a BMW, you kind of assure that this model will last you 5 years or 6 years without them coming back with a new model. So that's how, as the analogy that I usually use. And obviously the industrial space is a little bit different, but kind of give you a little bit of a ballpark, what technological obsolescence is in a way. Not from a car manufacturing perspective, but, things don't get super efficient, by an order of magnitude before, your old machine become, obsolete or valueless, right? So things have to be meaningfully better in order for you to, lose value for your investment. So that's on our first strategy of our model allocation. The second one is equity and coordination. And that's, the first, by the way, direct ownership, we allocate around 30% of our portfolio to that. The second one is, is equity coordination. It's actually the highest IRR. This is the highest convictions, high conviction positions. These are stakes in company owning the orchestration integration stack. This is the most defensible, position in the overall robotic, stack. Because once they're embedded in the system, the cost of replacing that orchestration is monumental. So switching cost is super high. For instance, it's easy to replace a machine because of obsolescence, but it's not easy to replace the brain that makes your machine work within a certain specific workflow. And margins in these companies, as I mentioned earlier, have around 50 to 70%. Think about them as SaaS margin of sorts. The third model in our asset strategy is combination of credit and debt. So it's you lending against hardware or against companies, who want to grow in the robotic space. So you're not buying robots and leasing it to them. So you're actually lending companies against a specific portion of their asset growth. They want to buy a robot, you can lend them, right? You don't buy the robot, but you lend them. And the collateral could be the business, the operating business, or the asset in itself. And usually you want to lend to companies that have obviously a very good credit and good underwriting, etc., etc. Then the last but not least, which represent around 20% of our portfolio, these are reserved, opportunistic, pools of capital that we kind of want to have at our disposal at any given time to take advantage of market dislocation. When we say we take advantage of market dislocation, it could be in the physical space or it could be in the pure capital market sense. So either physical space, there's a glut of inventory and the market is pricing those inventory at below replacement cost. That could be one example when we can intervene and buy the assets. Another example is this massive capital dislocation of the capital market, massive sell-offs. LPs want to exit their position in robotic companies because, as I mentioned earlier, they just have a window of 7 to 10 years, and robots and robotic companies usually needs to be owned for longer than that, and people just want out. And you are a provider of capital and they want a discount and you want a discount and they agree to that discount, and therefore you provide them with capital and you take on that equity ownership. So in essence, we think by having a diversified strategy across hardware, software, opportunistic, and credit, the portfolio will realize a return on invested capital that is actually not correlated with the general market overview or the economic trajectory. So that's our capital allocation model.